outperformance seems to be behind us. And going forward, we anticipate that emerging markets in general should do better than the US. And with all of this tariff tantrum that is going on under Mr. Trump's presidency, there's all the more uncertainty in the US. So our outlook is that for the next 6 to 18 months, there is going to be great uncertainty in the US. And there are two possible outcomes. One is if there is a US recession, then there could be a prolonged bear market. Right now, the US has just entered correction zone. But if there is a recession, there could be a prolonged bear market, which could last between 18 to 24 months. And at the same time, if there is no recession, which seems unlikely at this moment after the Trump tantrum, then you could still see a 6 to 9 month correction. So the general outlook is that, if you've been overexposed to US equity over the past 12 to 18 months, it's good time to cut allocation. You should bring down allocation to a more sustainable level. An 8-10% US allocation in Indian investors' portfolio is a reasonable level.
Okay, 8-10%. Oh, you're talking from the international point of view, or overall portfolio point of view?
Well, if you are an Indian investor, from an overall point of view, an 8-10% US allocation is good
enough. And then other international funds you can still look to invest in, right? Over and above this.
Yes,
okay. With this rupee depreciation, historical depreciation against the dollar, Fed's potential rate cut moves also now that we are keeping an eye out on, right? Still, we'll have the RBI decisions coming in next week as well. Overall, what should one watch out for as a strategy? If it is a new investor, I don't have any investment in US, then, given that you're seeing this correction, or, given that we could see a fall, does it make sense then also to maybe look at it from that, lower NAV point of view and build up on this as a long-term story?
So see, if somebody still wants to look at the US and thinks that, okay, this 10% correction is a good starting point for me to start looking at US mutual funds and US equities, then I think the best way to play that probably would be to do a staggered investment over a 12 or 18-month period. Because as I said, the pain is probably going to last for a bit. It's impossible to call a bottom. And in that case, the best bet for an investor is, if you have, let's say, 10 lakh rupees to invest, divide it over the next 12 months or the next 18 months and stagger your investment. And in such a case, what will happen is that if at all this correction continues, this bear market, this converts into a bear market, then you'll actually get the benefit of dollar cost averaging and better unit accumulation.
Right. Jimeet, now obviously when we talk about exposure to the US, we also talk about two specific sectors, that's pharma and IT. Now today pharma surely is cheering because as of now they're out of the woods. But IT, in terms of if there's a recession that comes in, the possibility of that which you're talking about, how should one play this story, right? Because they were said to be defensives. Now, when I'm looking at it in terms of returns also, last 1 year return, surely I'm checking on not a very, very long term, but just 1 year and 6 months return. For pharma companies, they managed to give positive returns in the range of around 12 to 19%, most of the funds. While 6 month return, we are seeing a decline because obviously pharma stocks overall were seeing a fall coming in the last 6 months. IT also, similarly, in the last 6 months is when we have seen that decline coming in, right? Do you think now this play will be changing and the decline that we've seen for IT stocks is something that could sustain? And as a thematic fund, if you're holding one of these, what should they be doing as a story? Pharma, IT, both separately? And now does it make sense to start playing those consumption capex themes also as a domestic play coming in?
Okay. So see, as far as the allocation to pharma and IT is concerned, so first let me talk about IT, because I think with this, if at all the US goes into a recession, then the most affected is going to be the Indian IT sector. And in case, investors have, and the thing about thematic sectoral funds, specifically sectoral funds that are focused on a particular sector, it's very important to get the timing right, because if you get caught on the wrong end of a cycle, you could see sustained underperformance and poor results from a portfolio perspective. So I think IT, the best, at least for the next 6 to 12 months, seems that it's behind us. even pockets of the IT indices, our systems suggest that there is excessive valuation, there is some amount of pressure that is yet to come in. So definitely that is one space to stay away from, at least from an incremental allocation perspective. And if somebody made an allocation at a lower level, it might not be a bad time to trim allocation. Now, coming to pharma specifically, as you rightly said, they are happy of the fact that they're out of the woods for today, but there is still going to be uncertainty of the fact that whether this is temporary or pharma is actually permanently going to be out of this whole tariff tantrum issue. So my sense is that the investors should not get swayed by the fact that, oh, our pharma has been left out, let's go all in pharma, and let's make this like a 10-15% allocation of our portfolios. My suggestion is that at best, if you're looking at sectoral funds like a pharma fund, they deserve a not more than a 4-5% allocation even for a risky investor, and which should remain the case. So don't try and go overboard with pharma, but yeah, I mean, considering the fact that it is one of the safer spaces to be in, and it is insulated from tariffs, at least for now, it may not be a bad idea to have some allocation as a part of your overall mutual fund portfolio.
Okay, some allocation is what one could go in for pharma, but don't go gung-ho on it, is what Jimeet is saying as well right now. Do you think my other point was in terms of consumption story, the capex story? You have so many options, right, on the thematic side as well. So I want to know, does that make sense? And, is it better to look at overall as a fund story, if I'm looking at multi-asset funds, where companies or where funds have more exposure to these consumption capex stories?
Yeah. So, when first, from an investor strategy point of view, I'll answer the second question first. If you are an investor who's starting out in 25, 26, has a 3-4 year outlook, I think the times that we are in the sense that we are going through a economic world war of sorts, and which has just started really now. And in such a time, it is actually best that an investor has exposure to multiple asset classes that are uncorrelated to each other. And I think multi-asset allocation funds are a great way to play that, because as a fund category, an investor will get exposure to equities, which will have some amount of domestic equity services, which form a part of the composition of the Indian indices. You'll also get some exposure to commodities like gold and silver. You'll also get some exposure to debt. So all in all, it actually will be a well-balanced portfolio to sort of make sure that you are able to navigate through this time that probably will last for the next year and a half or two at least. So that's point number one. Now, as far as, if you're looking at Indian consumption, that's a great story in the sense that if you look at the past 10 years, the Indian government has focused excessively on infrastructure spending, developing roads, ports, defense, all of that. And this year's, budget actually made a shift towards consumption, because it actually put more money in the hands of the Indian consumer, after the income tax slabs, which have actually gone in from the 1st of April. So a higher disposable income, we believe, will actually translate to better earnings for consumption names, better growth for Indian domestic consumption names, Indian lenders, Indian services businesses. So these themes or sectors could be looked at from an investor perspective. As I said earlier, when you are looking at a sectoral fund specifically, it's very important to get timing right. So you've got to get in at the right time, get out at the right time. Otherwise, you could get caught on the wrong end of the cycle. And if you're not feeling confident about timing it too well, then diversified equity funds or multi-asset allocation funds are a great place.
Absolutely, Jimeet. Surely an option that comes in on that front as well. Diversification is key wherever you're going, right? At any point of time. That's the key, and investors should always remember that, because every expert we talk to, time and again, diversification is something that will save you. If one thing goes downhill, there's at least something to protect you. Jimeet, what I want to understand is in terms of, if we reduce our exposure in terms of US, I still want some international exposure as well, right? Apart from US. What are the alternatives I have as an Indian mutual fund investors? What is looking attractive right now?
So we are an algorithmic asset management. The way we look at things is that where are trends moving, and one of the places where we believe that a new trend is emerging is Chinese equity. So China has actually been beaten down for the past few years. It's started to make a comeback sometime in the second half of last year, and especially Chinese tech after DeepSeek has seemed to sort of found a lot of interest and is beginning to show an uptrend. So I think if investors were to look at some other global asset allocation, then there are Hang Seng tech ETFs available. There are Hang Seng tech fund of funds that are available. And in general, that is a great space that you can look at. Again, as I said, don't go overboard, don't go gung ho, but a small 2, 3, 5% allocation will probably could act as a good upside kicker from an investor's portfolio perspective.
Right. Jimeet, while we do have China surely turns out to be one of those plays, right, as a story. And like you were mentioning as well, just I'm looking at the returns in the last 1 year. Most of the funds in India, which have a NASDAQ exposure and all of them, they manage 11% return. We also have options coming from Japan, other emerging market opportunities as well. There are funds on that front as well. Does that also make into play, and does that make sense that you could look at other emerging markets as a bet right now?
Well, I wouldn't classify Japan as an emerging market really. But yeah, as I said, at the beginning of this conversation, that we believe that going forward, emerging markets definitely will do better than US and in general developed markets. So looking at something like and in the emerging markets basket, the two big plays really are India and China. So, and if you're able to get exposure to India and China, then you pretty much covered bases. Then you can then look at some diversified emerging market funds that could probably give you some exposure to Taiwan, Indonesia, Korea, etc. But I think those are marginal positions. Broadly, if you're looking at the emerging markets basket, I think India and China is what an investor needs to focus on.
India and China is what the investor need to focus on. So you would say get out of something like a NASDAQ funds that you have on those sides, or US tech side, and come into maybe a Hang Seng side, or the China fund, or the India story is what you would highlight, right?
Yeah, that's right. So cut your allocation to the NASDAQ, cut your allocation to US equities, and reallocate part of that to a combination of, as far as the global portfolio is concerned, to Chinese equity as well as Chinese tech specifically, and then secondly to Indian equities.
Okay, Jimeet, thank you so much for that and explaining our viewers how this change in dynamics and how all this that is coming as an announcement in terms of Trump tariffs, what one should be doing with their US-based mutual funds, or in terms of pharma and IT as a sector, and sector-specific thematic funds as well. On that note, we'll slip into a very short break. Viewers, don't go anywhere, because after the break, we'll be discussing new regulations that have come into play in FY26, the new financial year. What does it mean for you as an investor? Anything that you should watch out for on that front, and how will it benefit investors? We'll talk about all of that with Jimeet, so don't go anywhere. Welcome back to Mutual Fund Corner on CNBC-TV18. We still have with us Jimeet Modi, founder and CEO at SAMCO Group. And now what we're going to be discussing, because there are some new introductions and new changes that were made by the SEBI that is coming into effect from FY26. There's some NFO fund deployments that is there, some rules coming in from the point of view of AMC employees and their participation also that comes in as an important play in mutual fund schemes. What does that mean? And also, what are the exciting options that one could look out for in terms of FY26 as a tax saving option now with the changes in income tax regulations? We'll talk about all of that. Jimeet, a lot of changes that are there, a lot of new things that have come in from the fund side as well, right? We have the 250 rupees SIP that is starting. A lot of funds have started on that front. We have mandates coming in from AMC employees. We have NFO deployments also. If you could break it down for us, what this means for a mutual fund investor, what will it entail for them?
Well, I think specifically from an investor's perspective, one of the more interesting developments is the requirement of AMCs to deploy NFO proceeds in a stipulated time frame. So earlier, what used to happen is that, let's say, a fund would launch an NFO, and it would take its own sweet time in order to actually reach the desired asset allocation as far as the fund is concerned. So let's say you invested in a large cap fund, and the fund manager decided, and you thought that you were actually getting 80% large cap exposure at least, because that was the mandate of the fund. But in case of an NFO, what a fund manager earlier had the flexibility to do was to wait for a while. He could decide that he was investing only 10% this month or 20% or 50%, and then gradually actually build exposure to the 80-100% kind of levels. Whereas now SEBI has stipulated and said that within a 30-day period, whatever deployment that has to be made of NFO proceeds has to be completed in 30 days. So you have to reach your fund mandate at least at the end of the 30-day period. So what happens with that is that even investors actually will get funds which, even when they put money in an NFO, the fact that the time from NFO deployment will get cut down, and they'll essentially get true to label funds. Otherwise, what would happen is that you would essentially be investing in cash, and the fund manager get paid for being in cash. So that aspect is really helpful from an investor perspective. I think, and the Choti SIP again is a great initiative. It will encourage more and more people from Tier 2, Tier 3, Tier 4 cities to look at SIP. While where typically 500 rupees or 1000 rupees were the earlier popular SIP ticket sizes, but yes, a 250 rupee Choti SIP could look at much wider participation, from a pan-India level, especially from, as I said, the Tier 2, 3, 4 towns. So I think that is again one more big development that's happening. And I think generally, like we spoke earlier in the conversation today, that there is a tax saving that investors are going to make in this year. Since the tax slabs have gone higher with effect from 1st of April, there is more disposable income in the hands of an investor. So you actually, I think investors, one of the best things they could do in the first week of April is top up their SIPs, because you've got additional savings. Don't wait till the end of the year. Actually get your money to start working from the first month itself, and allocate that extra additional saving to your investments, whether it is MF through a lump sum or an SIP route. But yeah, I think that's a great option for investors to look at early on in this.
Absolutely. Earlier on in the year, just top up your SIP, so you start saving more accordingly as well for the whole year. You will start on that compounding journey that you're supposed to. And Choti SIP, something that will support the growth coming in from the Tier 2, Tier 3 cities as well. Jimeet, what I want to know is also in terms of, right, while we said that the tax slab has gone up, but when you have the new regime that comes into play, that 1,50,000 that everyone used to put in that ELSS fund, that is, not that much effective now. That doesn't make sense for a new regime person. Are there any other options that are there as a tax saving opportunity for an investor in FY26, what they could start right now?
So you're right. I think even last year, as we saw, almost thirds of the Indian tax filers had moved to the new regime. And our anticipation is that after the increase in the tax slab in the new regime, probably that number will go to 85-90%. So, as you rightly pointed out, the whole ELSS category, in a sense, has actually become an irrelevant category from a tax saving perspective. So I don't think today, if you are in the new regime, you can actually try and game the system, or try and make those 1.5 lakh ATC allocations. That's not going to work anymore. I think the government just has said we've put more money in the hands of the end consumer, the end investor, and they can decide what to do. And all of these excess deductions have been taken away. So I think I don't think there is much scope left from a tax planning perspective in the new regime.
Yes, absolutely. And Jimeet, just one last word, right? Beginning of the new year. But what I would also like to know is, as an option that are there for investors to look at in terms of investing, where should they be looking out for right now? And which categories do you think would be somewhat of an outperformer in FY26? Because there are reports also that suggest, right, that one could see a faster pace in terms of growth coming in from the consumption side of the story. So what should we be looking out for in FY26?
So if you're looking at from an FY26 perspective, I think I'd look at three broad categories. The first is, like we spoke about, multi-asset allocation funds. So if you are a conservative investor or a moderate risk taker, the best way for you to participate in wealth creation journey is through multi-asset allocation funds. So that's point number one. As far as which segment of the market do we expect to outperform over the next 12 to 18 months, we are definitely more positive on the large cap space. So over the past 4-5 years, large caps have seen underperformance as compared to mid and small caps. Part of that outperformance is coming back over the past quarter or so, and we believe that 26, 27 is going to be the year of large caps. So even if you look at the share of CNX 100 to the CNX 500 is at levels not seen in the past 20 years. So that's a great space to be in. It's an ignored space. It's an under-owned space. So that's a space that you can look at from an investor perspective. And then specifically, if you're looking at themes and sectors, then as you rightly said, the consumption space is one space. So you should be looking at. So there are a bunch of consumption funds, non-cyclical consumption funds as well, that an investor could look at. Even in the Indian space, I think one of the great ways to play the Indian domestic consumption story is through financial services. So you will look at a financial services fund or a bank. And we anticipate that is also going to be a space which will actually outperform over the next 12 to 18 months, because there's great strength that we can see in bank financial services companies.
Right, Jimeet, thank you so much for, highlighting all those options that are available, what you believe as a story could play out in FY26, and highlighting what it means for investors in terms of the changes that we've seen in coming in for NFO deployments, as well as AMC employees, mandating that in terms of what their investment should be as well. So thank you so much for that, Jimeet, and thank you so much for joining in with us. Viewers, with that, we'll wind down this edition of MF Corner on CNBC TV18. Thank you so much for that. Up next, you have Closing Bell.
Go beyond market headlines to understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Starting tomorrow, the United States will implement reciprocal tariffs on other nations.
Futures on Wall Street cratered as these sweeping tariffs were announced.
We start sharply lower for the Nifty. We get to the first big support zone, which is 22. It comes in at 22,867.
Talking about tariffs, you'll want someone to come in there and bat for the bulls.
This is not a good policy. This is a very bad policy.
And 23,180 is where we are at. It's 150 points lower.
Tariffs are going up not only for India, but tariffs are going up for other countries.
I said more than 1%. I said 1% because of investment getting delayed.
With the increase in tariffs, how much inflation is going to be there in the US economy? And
Nifty Sensex down close to about 1/3 of a percentage point. The Nifty's at 23,280.
Tariffs are a part of an overall Trump agenda.
Lower, but we're still quite resistant today, especially, the mid-cap and the small-cap end of the market. It has not fallen as much, so that bodes well.
Okay, it is a very, very decent response to what was not kind or nice last night. The market here holding on, market breadth is positive and things are looking pretty all right. Just like any other day, I dare say. This is Closing Bell. We're coming to you from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Surabhi and Reema here. Nigel is joining us from the newsroom floor. Guys, hi, good afternoon.
Hi,
afternoon.
It's looking all right just for us because Asia closed in the red.
Yeah.
Europe is down 1.5%, and the Dow future